Geopolitical turmoil continues to hang over the market. Our guest says Canadian stocks are poised for modest growth through the rest of the year and into 2026. We're joined by Shiraz Ahmed, founder and CEO of Sartorial Wealth. Great to see you. Thanks very much for joining us.
My pleasure. Thanks. Great to be back.
When you look at Canadian stocks versus US stocks, do you have a view? Or, I mean, I know you're probably more interested in individual equities, but overall?
Overall, I think generally speaking, temporarily, I think Canada is poised to be a little bit better relative to the US while some of these trade tensions get sorted out over the not too distant future.
And what about the US? We have political turmoil south of the border.
Absolutely, and it's also very much a policy-driven market right now. We're looking at what the Fed is going to continue to do over the recent coming meetings, and we'll be able to get a better idea of the direction of the market in the not-too-distant future.
But of course, our economy here in Canada vulnerable because it's so exposed to international trade.
Well, absolutely. I mean, the United States is one of our largest trading partners, if not the largest. So we're in a very unique environment where our largest trading partner, our biggest client, is at risk right now. So we're looking at diversifying, and with Prime Minister Carney's new approach, I think there is definitely opportunities, but it's a bit of a wait and see.
You use a Quant model to rank stocks, and in March, that moved more towards utilities, telecom, and precious metals. Tell us a bit about that.
Absolutely. So we use a proprietary algorithmic trading strategy at Sartorial. So part of it is all about assigning momentum, frankly, what's moving, what's not moving. And over that time period, we found a bit of a pivot that ended up happening where we went a little bit more heavier into some utilities, also into, for example, American Waterworks in the United States. We did go a little bit heavier into gold via Franco Nevada, and also, again, telecom into T-Mobile. So that worked out quite well. It went more defensive, and more recently, it's actually starting to pivot a little bit more growthy again.
So tell us about, excuse me, a few of your favorite stocks. Franco Nevada, it's had this problem in Panama hanging over it, but you like the name.
I still like the name. Again, it's a way to be able to play gold without necessarily getting into the mining risk side of things. Again, they do have very strong royalty streams coming in right now. So we're still a big fan of Franco Nevada as a proxy play on gold.
What about this Cobra Panama mess, though, the problem they've had with their big investment in First Quantum's mine? Does that not deter you? So
it is a risk. It's there. It's one of the reasons why we're still cautiously optimistic. But overall, again, it has had very stable cash flows coming in. The dividend is still very consistent, and it's still a name that we like, again, as a proxy way of playing gold without necessarily taking the direct mining risk.
Right. And what attracts you about gold broadly?
Broadly, again, it's the ultimate vote of no confidence on a lot of the political risk that we have out there right now. So it's the ultimate way of saying, you know what, we're not sure, we're going to take in, it's a safe haven asset. So a lot of portfolio managers have always been hesitant about going into gold because of its lack of productivity. This is a way where you can actually get some cash flow, some dividend streams coming from an exposure to gold.
Your next idea is waste management, WM in New York, and our society will go on throwing out garbage, whatever happens.
Absolutely. It's one of those fairly, I guess, recession resistant. I mean, nothing is infallible, but it has done quite well over quite a long period of time. Again, millions of customers across North America. They're one of the largest ones out there. And we're again, big believers in waste management at the moment.
And that's interesting. Automation, they're using more robotic type technology to collect garbage and waste?
Absolutely. And they're adding in more and more every single day. So we're, again, overall quite bullish on waste management at the moment. What
would turn you off this stock? Because, I mean, a lot of their stuff is commercial and industrial, so they're not completely unexposed to the economy.
Absolutely. And again, we're momentum quantitative-based managers. So we do some fundamental analysis, but most of it is about price movement. So if there's a breakdown in the price momentum, then that's something that we would either start trimming or get out of it completely.
At Walmart, I didn't realize this, 19 countries and more than 250 million customers every week.
Absolutely. Again, they're such a multinational company. They have international revenue streams. They are reasonably resistant to some of the tariff issues that we have going on. And again, they're a fairly stable play. So over the past year, it's been one of our more consistent positions that we've held fairly substantial holdings in.
And it's interesting that we think of them as bricks and mortar, but they're getting better at e-commerce. They don't mess around when they get into something, and their e-commerce is growing.
Absolutely. Again, this is why we like Walmart for at least the last little while. And at least the way that things are progressing, it seems as though it's going to be a position for us for the time being.
What about Dollarama? Is that a stock on your radar in Canada? It's done so well.
So it's in our universe. It's not a current holding that we're currently looking at right now, but it is one that we have jumped in and out of historically in the past.
Right. Why? Maybe you can put up a 5-year chart for Dollarama. Why would your model not be in it right now? Can you give us any insight?
It's really primarily based on price momentum. So we look at a bunch of different securities that are out there within the universe. If there's comparables that have done a bit better from a price momentum and a risk-reward ratio basis, then we would jump in. So right now, it's not one that we've currently been looking at.
Shiraz, thank you very much.